Ready, we'll start.
Okay, sounds good. So good evening, everyone, and welcome to another finance webinar from the Finance Medic, or Dr. Syra Asher, who I'm sure you're all very familiar with now. So Dr. Asher is a academic foundation doctor in the Oxford Deanery and is also a chartered accountant. This evening's topic is on loans. It's quite a short talk. So Dr. Asher has said, with the Q&A afterwards, if you want to ask any questions at all, whether that's about previous sessions, obviously this session, or stuff that you want answered kind of in future sessions, post it in the Facebook comments. And as always, I'll be monitoring and passing those questions across. So over to you, Dr. Asher.
Thanks, James. So hi, everyone. So this installment is about loans. Now, it's not exactly a very large topic, but I think it's just really important to cover. And for completeness sake, I wanted to cover it. A lot of us will be starting our FY1 jobs. And for many of us, this will be the first job we've ever had. So the temptation to use your paycheck and the plans that you have for your paycheck mean that you might think of getting a loan to try and splash out on a nice new car, which you totally deserve, or to buy something, a holiday possibly, or to just pay off some debts that you've accumulated, such as for overdraft. So I thought I'd cover loans just to make sure that you knew the facts about it and knew what you were going into, and just what to look out for as well, just to get the best out of the loans you might look at. So we're going to talk about what is a loan. We'll talk about the types of loans. Sorry, it says student loans. It's just loans, my bad. And key facts about loans. So this is me, I'm Syra. I'm currently in the Oxford Deanery and I just started FY1. So this is our induction week. So what is a loan? Basically a popular method of borrowing. So you borrow money and it attracts a particular interest rate. These interest rates tend to be lower than other ways of borrowing, such as credit cards or overdrafts. Now, I have previously done a webinar on student overdrafts and they're normally 0%. But actually, once you go into a normal current account for non-students, the overdraft interest rates can be quite high, and you can actually get fines and penalties if you go from a planned overdraft to an unplanned overdraft. So a loan could be a better way of managing that. It covers a fixed period of time. So you agree to have your loan over a fixed period of X amount of months to years. And that means your payments are also fixed. So once the amount and time period is agreed, your repayments are fixed, particularly usually for one date per month, regardless of your personal situation. So you have to make that repayment regardless of if something happens with your job, if you're unable to work, or if there's an unexpected expense, you still have to make that repayment. So types of loans. So we've got 3 specific types of loans, and other loans are just they're just versions of these loans. So I'm going to go over these, and if you do come across any other loans, they'll usually be this kind of loan. So first one is going to be the personal loans, which you would have heard a lot about. Secured loans tend to be for larger amounts of money, and debt consolidation loans, which I genuinely hope you never have to use. So first of all, personal loans. So this is a loan that is based on your personal credit rating. Now, we've done a webinar on the credit score already, so feel free to go watch that as well. But basically, the better your credit rating, the more you can borrow and for a better interest rate. The maximum anyone can borrow is £25,000, and the maximum term for which you borrow is 10 years. Now, based on your credit rating, you might not get this level of borrowing. You might not be approved for this level of loan, and you might not be approved for this level of this period of borrowing as well. So always make sure that you're shopping around and actually think about what you need the loan for and how big it needs to be. The repayments are always fixed, regardless of what's happening in your personal life. And something I wanted to highlight is the phrase annual percentage rate, or APR. You would have seen this when On television, we were having a lot of adverts by payday loans such as Wonga. And in the bottom, in tiny, tiny, usually white handwriting, you'd have the APR, or the annual percentage rate. And it used to be something ridiculous like 1,000% or something really dumb like that. So the annual percentage rate is the interest rate and the cost of borrowing for each year, which means it's the interest rate added with all the charges that you might expect, and how much it would actually cost to borrow that money. So say you borrowed £1,000, it would tell you in percentage terms how much of that £1,000 you'll be paying as a fee. And so you might borrow £1,000 but pay back 1,200. So your APR would be 1.2%. So personal loans are available from high street banks and building societies and internet loan providers. You can get personal loans from actual like finance providers as well. And you wouldn't usually approach the more private firms because they tend to work in wealth management, and they would be doing other types of finance products as well. So the most likely places to get a personal loan would be from your high street bank. So next would be our secured loans. Now, the personal loans that I just talked about, they're unsecured. It means that they, in case you default or miss a payment, there's nothing of yours that's at risk of being repossessed. It's not secured against something or an asset that belongs to you. Whereas a secured loan is secured against an asset or a piece of property that belongs to you in case you default on the loan. So if you miss a payment or fail to repay the loan, the property or asset that you've secured the loan against can be repossessed. So usually this tends to be a house, a building. That tends to be what you secure loans against. It's very unusual to be able to secure a loan against anything else. It depends on the provider, obviously. It depends if you have, say, an extremely valuable work of art that you secure it against, or an extremely valuable car, but usually it's a building or a house. The maximum you can borrow is £100,000, and the maximum term you can borrow for is 25 years. Again, based on your personal situation and the value of your asset, you might not be able to borrow the £400,000, or you might not be able to borrow for the full 25 years. So keep that in mind, that even though that's the maximum you can borrow and how long you can borrow for, it might not be how much you actually get offered. Secured loans, because they have a lower risk for the lender, because they can actually offset any losses against the item or asset that they've secured against, they tend to have better interest rates. So even though you're putting your property at risk, hopefully, fingers crossed, it never comes to it. And it means that you can actually benefit from a better interest rate, and so a better APR. And lastly, debt consolidation loans. I just want you to know about these because a lot of people don't know that they exist, which means that, say you've been living on the edge over the last few years, you've accumulated a lot of debt on student loans, well, not student loans, on credit cards, on an overdraft that isn't a student overdraft. So you might want to bring all of that under one loan, which might actually have a better interest rate than the credit cards and the overdraft that you're currently dealing with. It means it simplifies everything. So you're only making one payment a month. The term might be longer, which gives you a bit more time to pay it off rather than the pressure of paying it off on a fixed period of time. And it pays off your other debts whilst giving you a better chance of being able to pay off your debt using this one simple loan. So debt consolidation loans are a specific type of loan in themselves. You have to apply for them as a debt consolidation loan because if you have debts already outstanding on a credit card or an overdraft your likelihood of being able to get an unsecured loan is lower because your credit score would reflect that you've already got debt outstanding. So in order to get around this, a debt consolidation loan takes into account that the credit card and the overdraft debt will be disappearing as a result of the loan paying it off, which means they can actually offer you more instead of the personal loan where they don't look at your current situation and what you'll be doing with the money. So that's why you specifically apply for a debt consolidation loan when that's your intention, in order to be able to get enough to pay the credit cards and the overdraft back. So those are the different kinds of loans. Some key points I wanted to make sure you were aware of: affordability. So please make sure you can make the repayments, even if there was an issue with your income for a couple of months. So make sure that you're able to actually make those monthly payments. And if there was some sort of hiccup, that you'd be able to cover at least a month, or especially 2-3 months, in case you were to have any issues. This is so you don't miss any payments and affect your credit score negatively. The next thing would be check the APR. So the annual percentage rate, which is all written in teeny tiny handwriting or teeny tiny print in a color that you can't read, and tells you how much it's going to cost for you to borrow that money over 1 year. Compare loans and find the best APR for you. Sometimes a slightly higher interest rate would mean you have lower charges. Sometimes higher charges means you get a lower interest rate. So these things will be reflected together as the annual percentage rate. The reason this APR came in was that because banks were able to sort of sell something at a really low interest rate, and then wham, they just stick some charges on there, and it wouldn't truly reflect the cost of the borrowing. An APR is a way of showing the true cost of the borrowing in an upfront manner so that you can make an informed decision. Next is an arrangement fee. So a lot of lenders may actually charge an arrangement fee to set up the loan. This might not be something you would have actually thought happened. I personally didn't realize this happened. I'm pretty sure from my friends who have taken out loans, most high street banks, depending on who they are, wouldn't usually charge an arrangement fee. So do ask about this and make sure you're aware if there is any arrangement fee. Where I have seen arrangement fees happen is on like online lenders and like payday loan lenders, because that's their way of making money. So I'd be really careful with them as well. They tend to have really outrageous APRs, and they just aren't a reasonable and affordable way of borrowing money. You are now earning a regular income from a reliable source, and you have quite a stable situation. The likelihood of you being able to apply for a loan now is much better than you would have been as a student. So please don't be tempted by payday loans in case you're falling short for a little while. Do make sure that you're checking all the available options. These include your personal loans, 0% credit cards, 0% overdraft for a graduate account. There are other options than taking payday loans, because once you get a payday loan, you may be hit with these arrangement fees. The APR can be outrageous and it actually costs you quite a lot to pay it back. And if you were to miss any of the payments, your credit score would be massively affected. And then the last thing I wanted to highlight is actually it's quite common for some lenders to charge an early repayment penalty. This is also true for mortgages. I'm doing a mortgage webinar week after next. And this is a bit of a plug. We're going to have a mortgage advisor who specializes in mortgages for medics to come and talk to us. So I understand that this webinar isn't specific to medics, and I apologize for that. It's just for completeness. I thought it was important that you understood these points about loans. But the mortgage webinar that's going to be in a week, not next week, the week after, will be by me, and it'll be specific to medics. And there will be a mortgage advisor there who can answer your questions, and he specializes in mortgages for medics and for locum medics as well. And all sorts of healthcare professionals, not just medics. Sorry, jumping back to the early repayment fee. So actually it's quite common, because if you were to pay back your loan early, the lender would be losing the amount they'd make in interest from you. So to stop this from happening, they'll apply something called a redemption fee. And it means for you to pay off the loan earlier, you get charged an early repayment fee. Now that early repayment fee might not actually be as much as the interest rate that you would have been, interest charge that you would have been paying to make the whole term of the loan. So it's worth seeing, is it going to be less of a cost paying it back early, or is it going to be less of a cost actually just living up the loan? You might have seen something like this with phone contracts as well, where you get charged a certain amount for trying to end a phone contract early, like you have to pay off the rest of the contract, or you have to have an early a charge for leaving the contract early. This is because of the money they'd make off you if you continued with the contract. So it's the same sort of thing here. So that was really it. So in summary, Don't borrow more than you can afford. Make sure that you've got a little bit that you can cover in case anything were to happen for a month or a couple of months, just so your credit score doesn't get affected. Make sure you look at the APR. The APR is the cost of borrowing over 1 year, and that will tell you how much the interest rate and additional charges together would cost you. Make sure you're aware if there are any early repayment penalties, and make sure that if there were early repayment penalties, what would be better, paying it off early and paying the penalty, or actually just seeing out the lifetime of the loan. The reason some people might want to pay it off early is because having that debt on their file makes it difficult to borrow something else. You might not be able to borrow as much for your mortgage, for example. If you have a large loan outstanding, you might be able to pay off the loan a little bit earlier, but you're going to be hit by these repayment penalties. So just keep in mind all of these factors when you're, first of all, taking out the loan, and second, if there's any other product that you were hoping to apply for later on, how that might affect it. Next thing would be missed payments. So missed payments are detrimental to your credit scores. Check out the webinar on credit scores that I've done. They actually impact credit scores quite significantly, and a missed payment remains on your file for 6 years. So it's not going to go away anytime soon. If you can avoid missing payments, do so at all costs, because you will struggle to borrow more, or struggle to borrow the same amount as you were able to after your credit scores hit, and it takes a while to build it back up. And the last thing is just look out for other charges, such as arrangement fees and things like that, and make sure you take that into account when you're getting the loan, because these additional costs you might not have factored in, and they might make the loan unaffordable. So just make sure you've got an eye on that. Okay, so please do give me your feedback. I use it, I read it, I go through it thoroughly, and I make sure that I've applied it to the next one. I'm probably the third time I've said it now. I am sorry, this isn't specific to medics. It was for completeness. I wanted to make sure that you had an awareness of how loans worked and what they meant and the pitfalls around them. But I'm happy to open up the floor to any questions, not just about loans, but any other finance topic that you want to ask about. If I've already answered it in a webinar, I'll be able to direct you there or answer your question directly here. And if there's going to be a webinar about it later, I can let you know.
Okay, thank you very much, Sarah. Very informative, as always. At the moment, looking at the live Facebook, we don't have any questions coming through at the moment. I've posted the link to the feedback there as well, and just giving everyone a reminder that even if you watch it kind of as catch up, please, still fill out the feedback form and we will get hold of it. So one question has just come in from Farhan. So anything about Islamic loans?
Okay, Farhan, thank you for that question. That's really interesting. From what I understand about Islamic loans, it's meant to work in a specific way, because I believe, I thought for earning interest, it had to be under a particular type of rule. So what I'm going to do, Farhan, is actually go away and look this up, because I genuinely don't know. I understand for earning interest, there's certain rules, but I don't know what the payment rules are. So let me go away, and please check the comments again. I'll answer your question in the comments when I've gone away and had a look. I'm really sorry I can't answer straight away, but I will go have a look for you and answer that for you.
Cool. Thank you. Hopefully, you'll be able to have your question answered not too long. I'm just going to give it another couple of seconds just to see if any other questions roll in. Oh, yeah, one has popped up. Oh, no, it's not a question. It's just Farhan saying thanks.
No problem.
No, good to know that it's appreciated. But no, that was definitely useful. It's just good to have a grounding in all the different terms that are used to advertise these things, and then someone kind of comes to tell you about a loan or an offer or whatever, actually being able to make an informed decision or understand what it is they're talking about, and perhaps, as you've said in the webinar, decide that maybe it's not the best thing always. Okay, yeah. Anything you wanted to add before we go, Sarah?
No, I wish you all the best of luck. The upcoming webinars are more medic specific. So we've got our mortgage webinar coming up. That will entail what's specifically available for healthcare workers and doctors, and what to look out for. And then after that, there will be webinars on the financial implications of locoming. So I will talk more about how it affects you in terms of tax, how you would deal with your national insurance and tax payments, your pensions, and what kind of financial implications it has for you. So that's very medic specific. And the one after that will be directed towards international medical graduates, because I understand a lot of our viewers are international medical graduates and would like to know what things are either available specifically for you, or what rules are actually on at the moment that might prevent you from getting products that I've talked about. So I'll be focusing a lot of that entire webinar on international medical graduates. And I understand that Mind the Bleep has an international medical graduate section. So I've reached out to them and I've asked them for any specific issues that are popping up. And something they've raised to me is about the costs of visas and how that works, and your right to certain public funds and recourse to public funds. So that's something I'll be covering as well. I hope that'll be useful for you guys. If there's anything specific you'd like me to cover in any of those, then just please drop a comment. I'll be more than happy to do so. Those are the 3 webinars coming up. So if you have any other topics you'd like me to cover, I'm more than happy to put on a webinar about that. But thank you so much for listening. Thank you so much for watching.
There's one question has just come in. Sorry,
okay.
Zara. So it's actually kind of quite fitting with the webinar that you have planned for next week. So it's from Mancy, and they say, if we want to buy a house, which financial advisors or mortgage advisors can we approach for loans? And are there any specific services that are just for doctors?
Okay, thank you, Mancy.
I mean, I can say yes. Do you want to give them a sneak preview of next week's session?
Okay. So this is week after next, not next week. So 10th of August. I'm sorry, Mansi, you're gonna have to wait for then, and I don't want to do any spoilers. But yes, there are specific mortgage advisors for medics, and there will be one joining us next week. Well, the week after next as well, to answer all these questions. In the meantime, if you're in an absolute hurry, I would look up Yes We Can. So Yes We Can on. Just type that in, mortgage advisors. They're quite familiar with doctors and healthcare professionals. The other one who will be actually joining us is a fellow called Tom Davies. So if you'd like to look him up on the internet as well, he's a medic-specific mortgage advisor. I don't want to spoil too much of the webinar, so I'm going to leave that there. But there's some food for thought for you until the webinar on the 10th.
Perfect. Thank you very much. Hope everyone enjoyed this evening and enjoy the rest of your evenings.
Thank you.